Hello, hi, how are you all? Good morning and welcome to our EEP event where we are going to go over the Earned Equity Program, give you some of the ins and outs on how the program works, the guidelines, and then we'll do a Q&A session for any questions you might have, any scenarios you might have. First of all, let me introduce you to Norma.
Hey everyone, thank you for joining us today. Really glad that you could join us. I know I've talked to several of you, and this is going to be really more diving into the program versus, the information that we've sent to you. So just continue to, stay connected with us. Check us out. We offer other products, not just the Earned Equity Program. Check our pricing. We are very competitive. So just keep us in mind when you have those conventional FHA, USDA, or VA loans. We're here to service you all around. So with that, let's just go ahead and jump into this great training. Thank you, everyone.
All right, here we go. I'm going to share my screen. I was having some technical difficulties, so sorry for starting late. Okay, so again, I'm going to introduce myself. My name is Monique Manaya. I've been in the mortgage industry since '97. I've been in all aspects of mortgage, and recently I was the EEP production manager over at the government entity. And so I ran operations over there. I bring over a lot of information to help you build your EEP business. I love this program. I'm invested in this program. And so I'm definitely wanting to help guide and lead you guys through EEP. It is a little bit more of a lot of moving parts on this program, but Norma and I are both here to help you through it. Speaking of Norma, she's been an account executive for multiple decades, and in the mortgage industry, mortgage insurance, and sales. And I know that Norma cares about you guys. She wants to see you guys succeed. I see that in her emails, her messages to me to make sure that we're always out there helping you guys and walking you through everything. So make sure that you reach out to her or myself if you need anything at all, any questions, concerns. So let's get started on EEP. So one reason Trevisa is bringing you EEP is because they really feel like we can get equitable wealth to people through ownership that traditionally do not qualify. And so they really don't, I'm sorry, I just lost. No one serves first-time home buyers better than Trevisa. And so that's one reason why they really wanted to, get involved with EEP and bring EEP to you all and have us here to assist you with it. So let's go further into EEP. It is the Earned Equity Program. And let's talk about the special case of the Earned Equity Program and how it works. So essentially, we have a government entity that is a Native American tribe by the name of Tule River. So Tule River is the one that is actually going to purchase the home on behalf of your home buyers. So what we'll do is we will have your home buyer get pre-approved through Tule River to enter into the homeownership agreement at closing. As soon as Tule River pre-approves your home buyer, they can go out and they can find the home that they want, the home of their dreams. They will put that home under contract, put down the earnest money, and then there's an assignment addendum will then get signed by all parties. And this is what transfers the contract over to Tule River so that they can proceed with the FHA financing to purchase this home. At closing, there's a memorandum that the government entity signs and enters in with the home buyer. And then the government entity, Tule River, will sign on the FHA loan docs to provide the funds to close with the home seller. Okay, so when you're looking at the full the full EEP transaction, the government entity is at the base because they're the ones that are then going to have the relationship with the seller and then the relationship with you and your home buyer. So the home buyer will enter into this home ownership agreement. It gives them full rights of ownership. It gives them appreciation. They get the tax benefits at the end of the year. They're going to receive a 1098 interest statement, so they get to write off the taxes. They get to do anything that they want to the home that makes it theirs, except for anything that requires a permit from the county or the city. That is still allowed, although at that point they would need to contact Tule River Servicing Department and get them involved to get the process going and get it all approved. So truly this is their home. Tule River wants them to feel like it is their home, that they can do what they want and really truly make it theirs. So a few of the program highlights for EEP, and these are the main items that makes EEP really work for your home buyers, is we allow 3.5% down for your ITIN non-permanent resident aliens, including DACA. We offer low and no credit scores. 3-month bank statement programs, and this 3-month bank statement is not only for self-employed, but it's for 1099 and W-2 employees. With DTIs up to 50 over 60, there is no source or seasoning of funds to close. So if you have a home buyer that just, doesn't have that warm and fuzzy feeling about banking institutions and they save all their money at home, that's completely fine. When you're submitting the file, if their bank statements do not show sufficient funds to close, you'll just put in a letter of explanation that the home buyer saves all their money at home and that they'll be depositing prior to close. Bankruptcies are also okay. They can be in a bankruptcy and we just need it discharged 1 day prior to closing. Because this is an FHA loan, we go by all of FHA property types. So 1 to 2 units, PUDs, condos, manufactured homes, and also the seller contributions of up to 6% of the sales price. I do want to note and make sure that everybody remembers that the seller contributions cannot go towards the entity's fees. Okay, so I'll go over the entity's fees here in a bit, but just remember the only thing that can go towards the Tule River fees, the program fees, is going to be the home buyer's own funds and or gifts. Okay. So if you do have self-employed borrowers and you are looking at their expenses, we do have a standard 45% expense factor, but we do have a tiered expense ratio option. So we do understand that we have some borrowers that are service business related where they don't really have that much overhead in their product business and they may not have any employees. So with some extra documentation like a CPA letter, we can get the expense factor all the way down to 10%. And same with product business. If say they have one to 5 employees, we can get their expense factor down to 25%. So very big for your home buyers that, we've used this for real estate agents. Technically they don't have any employees, they really don't have any overhead, and so we can get that down to a 10%. That's just one that recently stuck out for me. Okay, so when you are looking at qualifying your borrower, you're looking for home buyers that don't qualify for traditional financing because their citizenship and perhaps their ITIN or DACA. We have the doc types for the 3-month bank statements that comes, I would say that's probably the largest income doc type that we use here is the 3-month bank statement. But we also do have the traditional W-2. We only need one prior W-2, 1 month bank statements, and a written VOE. Some other items that you're going to be looking at is minimum FICO score of a 580. And we only need one major bureau. So if you pull 3 bureaus and only one bureau pops up, that's fine. It just has to be a 580 or higher. If you pull credit and no scores pop up, that's fine as well. We can do a no score program. They just need to have 2 alternative trade lines. Verification of rent for 12 months. We require a verification of rent filled out by landlord. Private landlord is okay. Apartment complex ledgers, things of that nature. And they only need 12 months of employment. So you only need to disclose 12 months of employment on the 1003. Obviously, if they have longer, that just strengthens the file, especially if you're needing exceptions for maybe your DTI is a little over 60 or something of that nature. And then also assets. So for proving assets, it's 2 months bank statements, but again, we don't source or season, and then gift funds are allowed. So specifically when you're looking at qualifying the property and when you do go through underwriting with your property, there's a few things that you definitely need to be aware of. And that is that the government entity has an overlay. They require a pest termite inspection in 35 states. They also require a home inspection for any properties where the appraisal comes back and it's a C4 or greater in regard to condition, or it's a 1978 or older. So this is an and or situation. If you have a property that was built in 1995, but the condition comes back as a C4, you do need a home inspection, okay? Anytime you need a home inspection, you also need a certified home warranty with roof replacement coverage. And aluminum wiring is ineligible. Also, for any HOA or PUDs, the HOA, first of all, needs to be FHA approved. We do not allow spot approvals. And we do need CC&Rs and bylaws or a letter from the HOA saying that they allow non-owner occupied purchases and tenants. The reason for this is that if we don't verify and confirm this, we had a situation where this wasn't confirmed and some home buyers moved in, but because they weren't the actual buyers on the deed, because they won't be on the deed, they're not vested on title, they're on the homeownership agreement with the memorandum that's recorded on title. They would not give them access to amenities. They were having to pay a few $100s a month in fines. And so we definitely want to vet that and make sure that, this doesn't affect our home buyers when they move in and they suddenly get, restrictions placed on them with extra fines. So that's the reason why we need to find that out, is basically to make sure that your home buyer is protected. All right, so talking about the funds to close again, essentially for the FHA file, we need to meet MRI. And so we highly suggest that you try to get seller concessions to cover all of the closing costs, discount points, anything of that nature, so that the bottom line from the FHA CD ends up only being MRI, which is 3.5% down minus earnest money. And then the government entity, the Tule River, they charge the first month payment. The first month's payment total includes Tule River's 30-year fixed plus their servicing fee. Their servicing fee is 0.5% times the total loan amount divided by 12. For example, on a $300,000 purchase, that servicing fee is going to be $125 a month. Okay. And as I had mentioned earlier, this servicing fee really is a huge benefit to your borrower after they've closed and they need anything I've had sometimes some people call in where for some reason, whatever school district they're in, they're not viewing the homeownership agreement. And we have Tule River people that in the servicing that get involved and help get the kids registered for school. So they're there to really help the home buyers. The other fees that are involved are the entities fees. So we have $12.50 underwriting and processing, $150 notary fee, 0.5% homeownership agreement fee, $250 HOA fee, if applicable, if it's in an HOA or a PUD. And fees may differ in Texas. And then also remember that MRI still must be met on the FHA transaction. Okay, so let's get into the 40-year EEP structure. So many people have asked and said, well, I heard that the payment is 40 years. So that is not true, but there is a 40-year element to EEP. So as I had showed you on the slide before, your home buyer's payment is based on Tule River's 30-year mortgage payment plus the servicing fee, okay? The homeownership agreement that your home buyer enters into with Tule River is a 40-year structure, okay? So the program is designed so that there is no equity share and no back-end split, okay? So they have it as a pay-as-you-go model versus taking appreciation later. So what this means is the tribe is not going out buying homes for people for free. And so instead of charging a lot of money up front or sharing the equity, they have got it into a revenue plus asset growth type model. Okay. So the payment from the client is spread over 40 years on the homeownership agreement, but this creates a fixed differential, and the differential is booked as an asset for the tribe, for Tule River, okay? So what this allows is it allows 100% of the home appreciation to go to the home buyer, but it also allows flexibility to where the home buyer can make extra payments to reduce the principal faster. So there's a slower initial principal reduction versus the FHA loan. So I'm a really handsy person, sorry, when I talk. So we have 30-year FHA mortgage, and then we have the 40-year EEP structure. So the 30-year principal reduction is going down faster than the 40-year. What this creates is that differential, right? And so when the home buyer, let me give you an example. The home buyer was selling the home after 18 months. After 18 months, there was, I would believe it was approximately $32,000 in equity that was built, but because of the differential, there was an $1,800 fee involved they call this the option price. Okay. So in order to pay off the option price, there was about an $1,800 difference from the 30-year, the government entities, Tule River's 30-year payoff versus the option price of the 40-year. And so when they sold the home, that $1,800 was just taken out of the $32,000 appreciation. And, Tule River made their money for the short time that the home buyer was using this program as a pathway to homeownership. And this is the way that they've been able to give all of the appreciation to the home buyer. Okay. So it definitely balances out the tribal's financial objectives with the home buyer's wealth building. But it is a strong alternative for buyers unable to qualify for traditional FHA now. They're getting into a home, they're building appreciation, they're not paying 100% in interest to apartments or a landlord and paying off their mortgage. So this is just a definite great alternative until they can get into a traditional loan, assume this FHA loan, sell the home, but they can always utilize EEP again. They can sell the home, take all that appreciation and put it down on another home And, if I know most people end up selling homes. I think the I think it states that it's like every 5 years that most people will sell the home and buy a new home, whether it's upgrading or downsizing. So please make sure if you have any questions regarding this structure to write them down. We're going to have a Q&A after. I want to make sure that everybody is clear on this 40-year structure. The other great part about your borrower entering into EEP with the homeownership path to legal is that securing their rights. So they can go, and I know that early 2000s, lease with option purchases were huge, but they were more benefiting the homeowner because the buyer wasn't getting any of the appreciation on the home, the equity, and B, there wasn't any guarantee that that home buyer wasn't pocketing the money and then the home was going into foreclosure a year later. So having the memorandum that's recorded on title, it really secures your home buyer's rights. And it's through it's through a government entity. It's through the Tule River tribe. And so it's not through an individual. It's through these people that have put this program together because they want to help people, not because they want to hurt people. So a few tips and tricks for a smoother submission. You want to make sure that you're including the cover letters for the credit situation, maybe your income structure. You have a home buyer that is W-2'd but has a business on the side, assets. They're going to deposit all their funds to close in a few weeks, or they're getting a gift. One thing that you want to make note and remember that is if you're doing the bank statement program and your home buyer is self-employed, but they don't have a business account, they deposit all of their income, their business income in their bank statements. We need to highlight and make sure that we're outlining to the underwriter what deposits are income related. Okay. Making sure your 1003 is fully complete. They will bounce it back to us if we don't have addresses, phone numbers, positions, things of that nature. Letter of explanations, perhaps they own a current home. What's the disposition of that home? Are they going to keep it, rent it out, sell it? And then we have some income calculation worksheets that you guys can use that helps you calculate the income to make sure that, we're looking at good DTI ratios. So the workflow process and setting the proper expectations is something that is extremely important, not only for your buyer, but for your realtor partners. There are a lot of moving parts to this EEP transaction. So not only do we have two files, we have a two-file structure. And if you ever want to join our TPO Connect training, we do those Tuesdays, Wednesdays, Thursdays at 10:30 a.m. Mountain Standard Time, 9:30 Pacific. I go specifically in detail about the two file structures, what needs to be in each file, how you submit them, what comes next. So the two file structure, you're working on two sets of conditions. Your property, not only, do you have an appraisal, an FHA appraisal that might need repairs because it's subject to, but you also might need a home inspection, and then that needs repairs, especially if they're safety items. And then for closing, your home buyer is going to wire the funds to close to Tule River. Tule River will then wire the bottom line of the CD2 title. Okay, so we have wires going around. We have closing packages. The tribe will sign the package. They're out on the reservation in Porterville, California. The nearest UPS FedEx drop is about an hour away. And so they only have limited time to sign these packages, pack them up, drive them over to FedEx, UPS. So if there's any delays, then the package could get missed. So we're looking at a 1 day delay in that aspect. So making sure that everybody understands this is not a same day close fund. It is not going to ever happen that way. Our best bet is close, fund the next day. If any of these issues may arrive, then we're looking at funding the next day. So making sure everybody understands that is very, very important, especially letting them know up front so they know what they're ahead of. So we do have some critical components for a successful EEP file, and I'm going to actually let Norma take over and go over these critical components.
Thank you, Monique. I appreciate it.
Absolutely.
So we definitely, you guys, these loans are closing. You guys can become very successful with this program. It can be done, but there are some things that we definitely want to make sure that we pass along for you to have a successful closing. So these are the list of items that we've identified that will help you make sure that closing goes as smooth as possible. So the HOA approval by the entity. And Monique, this is something that, the entity has to make sure that they've read the CCNRs, correct, Monique?
Yep.
And then there is an element that they're looking for, Monique. What is that specific element on that CCNR?
They're specifically looking for the CCNRs to not say that they do not allow the homeowner to rent out the property.
Correct.
Okay. So
Exactly.
let me give you an example. So I live in one of the biggest PUDs in the United States in South Jordan, Utah. It's called Daybreak. When I closed on my home, I signed a document that I would not rent out my home for at least a minimum of 1 year. So the underwriter is looking for things of that nature to ensure that we all know that this is a non-owner occupied FHA loan that the entity's obtaining, and they're immediately leasing it out, if you would say. So making sure that the CCNRs do not have any verbiage in there that says that they cannot lease it out. And or if you can get that letter from the HOA, then they'll accept a letter as well, not just the CCNRs.
Correct. Now, the assignment addendum, as she mentioned earlier, this is where you guys are going to have that, very, very close conversation with their listing agent. You want to make sure they're on board with you ahead of time. Talk to them about the program. Let them know that the assignment addendum is definitely something you want to have ready for when your home buyers are ready to sign the contract. So then the seller is there and everything gets signed at the same time. And as Monique already reviewed, this is where the home buyer is giving the rights to Tule River to purchase the home on their behalf of on this contract. Then if the bars are retaining their existing property, Monique, you went over the ratio reduction then to qualify. Instead of 50/60, it'll be 40/50. The pre-approval checklist, right off bat, submit the file. That checklist needs to be there before it can go to the government entity. So make sure that one is there. If not, it sits in our bin until we get it from you. Also making sure that you've added that reference name and phone number at the bottom of the second page. FHA condo approvals only. Don't go for spot approvals. Basically, they're not going to happen. So as soon as you find out they're looking at condos, verify that they're approved, FHA approved. The overlay on this program is they're going to require a pest termite inspection. Okay, so just they're attaching the VA guidelines for that. So just go on the website for VA for what states require this. Property inspection, as Monique went over, the year the house was built and the appraiser condition classification will determine that. Check out the house. That will tell you, that property inspection could come back with some repairs that may need to be done before closing. and that could delay your closing. So keep in touch with that listing agent, but also with us once you find out what that property may look like. That approved title company. Again, that conversation with those listing agents is going to be critical, because you'll need to have that discussion. If they don't use one of the approved title companies, they can get their title company approved. However, you may potentially be adding another 3 weeks to your closing. The approved hazard insurance, same thing. Check with us. We would recommend that you use the government entity list of hazard, that they will request the hazard insurance for your loan. And then the seller credits. Just don't forget, the seller credits will cover, just like a traditional FHA loan. However, it will not be allowed to cover the program fees, okay, for the government entity. So keep that in mind. They can be the home buyers can get a gift, but not be able to include that in your seller credits. So these are the highlights. But again, critical to make sure that you successfully close your loan.
Yep. Great. Thank you so much, Norma.
Of course.
All right, so just recapping on I-10 competitive market, because a lot of this program was developed for specifically I-10s, although we know that this could work great for your self-employed borrowers, and it's a pathway to homeownership. They want to get into a home now at today's prices, but they just need to maybe file some good tax returns for the next 2 years. So bankruptcies as well. They don't have the 2-year waiting period for bankruptcies, but for the I-10 market, Trevisa's earned equity program, 3.5% down, only 3 months bank statements, a 50 over 60 DTI, and a 580 minimum credit score with only one major bureau. So this is a very, very aggressive program for your I-10 borrowers. We have a lot of support here, and like I had mentioned earlier, Norma and I, we want to support you. We're here for you. We also have the EEP Support Center. There's a dedicated phone line and a email, EEP questions at Trevisa Financial. So these come to me. And so, of course, if I'm in a training or in a meeting and I don't answer, please shoot me an email and I will get back with you as soon as possible. But yes, all of this comes to me. And so I know that the head underwriter over at the tribe is revamping a lot of the guidelines, he said the other day, for the better. And as soon as he's done with that, he's going to shoot that right over to me, hot off the press, so I can get all the new guidelines and get those memorized so that I can help you guys even better with your scenarios. We also have a lot of resources for marketing. We have flyers available. So any of these flyers, reach out to us. We can put your name, your company logo on these if you want to start sending these out, to your home buyers, advertising them on, whatever, maybe social media, wherever you guys may advertise them on. We also have this EEP training that we can share with you. So if you want to start doing any of your own EEP training events, we can definitely share this with you. We have a section where you can put your own logo and name on it as well. And then the weekly trainings that I mentioned. We also can set up a private training if you have specific realtors or operations that needs to come to any of the trainings and you feel like you need a private event for that. Okay, so now it is time for Q&A. If you guys have any questions at all. Oh, we do have some questions. Hold on, let me start from the top. Yes, first question is, will we get a copy of the presentation? If you want a copy of this presentation, shoot me an email and I will send you a copy that, again, you can add your own name and logo so that you can do some of these presentations yourself.
And Monique, is your email available on the chat?
No, but I will add it right now.
Great.
Okay, our next question is the home warranty is needed regardless of the home inspection. Okay, so the home warranty is only needed if the home requires a home inspection. So if the home is not 1978 or older and or comes in with a condition of C4 or greater and you do not need a home inspection, then you do not need a home warranty. I know a few years ago when I was running EEP, you did need a home warranty no matter what, but that has changed. Hopefully it stays that way with these new guidelines that are coming out. Okay, so the next question is, you mentioned 40 or 50 DTI and 50 over 60. What is the right answer? Or explain. So the standard DTI is 50 over 60. The only time that your home buyer would be subject to the DTI of 40 over 50 is if they are going to retain a current property that they are currently living in. So if they have decided that they don't want to sell a current property, and they want to retain it and rent it out, then they're subject to those lower DTIs. They also need to have 3 months reserves. Okay, so that's the clarification on that. Okay, I put my email in. Did I spell it right? Because I was going so fast.
Yes, it's fine.
Okay. For hazard insurance, the borrower gets this in their name or is it in the government entity's name? So because they're signing a homeownership agreement, there's a few different ways you can get it. Okay, there's 2 different ways. We can request it for you directly through the entity, and the entity will provide it, and it's in their name. It's in their name, and then I believe it also has an interested party that is your home buyer. Okay, or
So, go ahead. Sorry.
or you can provide an outside homeowner's insurance policy, although this does need to be sent to the entity for approval. There's, I think, a list of 10 requirements and 3 documents that need to be signed. I've seen some of these go through smoothly, and I've seen some at the end fall apart because the agent won't sign a certain form. So this is my personal suggestion and opinion, is to get it directly through the entity. They work with a specific company that they order so many that they get a pretty good rate. Norma, did you have something you wanted to add?
I was just going to clarify. So the policy is going to be in the home buyer's name or the entity's name? I think that's her
So
question.
yeah, so if you get it from the entity directly, it's going to have it as in the entity name with the additional insured as the home buyer. But if you procure it outside, it's going to be in your home buyer's name with Tule River as the additional interested party. So either way, it's in your home buyer's name. Just different formats depending on where it's procured through. Did that make sense? Okay.
Which fee can the seller contribute to or gift funds can go towards the file? Towards
Okay.
the 5%?
Mm-hmm. So the seller contribution cannot go towards any of the entity's fees, including the first mortgage payment. Okay. So the reason for this is all of Tule River's program fees are on what's called an ICCD, which is an initial consumer cost disclosure. They're not on the FHA-CD. And we all know FHA guidelines have certain restrictions to what seller concessions can go towards and what they can pay. Because the Tule River program fees are not on the FHA-CD and they're on their own ICCD form, the seller cannot contribute towards any of those program fees, which are the first month payment, 0.5%, $12.50 underwriting, $150 notary, and $250 if it's in an HOA PUD. Those are all the fees that the seller cannot contribute towards. A gift can go towards those fees. Okay. I do not believe land is included for the reduced DTI. I think we just need to get the property taxes on it and include that in the DTI. If you have a specific file that comes up and we get a pre-approval for it, we can send it in for pre-approval and I can talk to the underwriter about that one. So if you're going to submit that for pre-approval, send me an email, let me know the specific file, and I'll have them watch out for it. How long do you suggest from contract received to closing funding? So that is a tricky question, right, Norma? I would say that, you have new constructions that can go through really fast because, we don't need home inspections. We know that there's not going to be termite issues. Everybody's eager to close, including the builder. So those, you're looking at probably, standard 30 to 35 days on transactions of that nature. Okay. Depending on the property is when you're looking at longer. When I had the numbers in front of me over at Tule River, I will tell you that the average was 37 days. That was the running average for the last few months that I was over there. So there are some loan officers that have been utilizing this program for quite a while now, and they can close some in 20, 22 days. But that's because they know the program now, they know what's needed, they know exactly how to structure them. And I think that, given some time, you can become the same way. But I will tell you that your first 1 to 3 files, they will be bumpy. It's going to be completely different for you. So just know that Norma and I are here for any questions. If you get lost on the process flow, reach out to us. If you need clarification on something that's needed, reach out to us. But that's what we're here for.
And just remember on the turn times, we're going to shoot for your closing date, right? So let's say you get a 30-day closing. We encourage you to, again, that conversation with that listing agent on the program, give yourself a buffer of 15 days that you can request them to give you an extension. Again, for anything unforeseen, but again, we will work to shoot for the closing date. However, again, as Monique mentioned, there are several moving parts. We are also subject to the government entity turn time, so that could, affect it. So just keep that as a rule of thumb. And again, the property will definitely be something that you want to keep an eye on. And I know we're going over time, Monique, so
We'll
let's
just
go through these.
really quickly, is there a formula to calculate the monthly servicing fee? So right here is the servicing fee calculation. It's 0.50% times the total loan amount divided by 12. Actually, I think that's purchase price. No, it's loan amount.
Loan amount.
Okay. So here's all of the entities fees. If you want to take a screenshot, here is the first month payment, and then just a list or the down payment and FHA closing costs. Remember, we have to meet MRI 3.5% down minus earnest money.
And we go over a great tool calculator on our TPO Connect training. So if you want to sign up for one of our TPO trainings, Monique will go over that calculator, or we will go over the calculator so that it just calculates these numbers for you. So
right. And then sending in files for pre-approval prior to the buyer making offers. Yes, we strongly advise you getting your file number 1, phase 1 submitted, which we call the home buyer TBD file. Get that submitted, get it pre-approved, and then let's go out and have them start looking for a home. I highly suggest that you register for our TPO Connect training tomorrow at 10:30 Mountain Standard Time. I will go through both files, how they're structured, the process flow, and everything, so that you can have a good hang on how that works. Can seller paid cover the first month's payment collected at closing? No. So these two fees right here, the first month payment and the entity fees, cannot be covered by seller credit. And this is because seller contributions are only allowed per FHA guidelines to go to cover certain fees that are on the FHA CD. None of these fees are on the FHA CD. We are going to have our separate FHA CD that is Tule Rivers for their closing. We're going to take the bottom line from that, add in the first month's payment that is on an ICCD, and the entity fees that are on that ICCD to give us our total bottom line. Okay. So these fees cannot be covered by the seller concessions. All of this has to be brought in by your home buyer or can be gifted. Okay.
And remember, everyone, we are hosting these trainings every week. So just go on to our website, our link, and if you want to do, repeat, come back and go over the program again, you want to go see the TPO Connect training as well, it's available to you guys. Oh, there's one more question.
Unfortunately, there's not a formula to calculate the equity split because in this current market, we can go online and we can Google what current, estimated appreciation markets are in right now. I can do that for my local area, or, I can do that based off of my county assessor. But we can't really, you don't know what the equity split's going to be because you don't know for sure how much the appreciation is for sure 100% going to be, and how long they're going to keep it. But you can Google market analysis from the last maybe 2 years, and then you could give them what an approximate would be in 2 years based off of what history trends are showing you. But we don't have anything like that because there's no way for us to guarantee what their equity would be at in any certain time.
And Monique, for those that are sitting in here as well, can you clarify the term equity split here, just to make sure that we're not confusing the program?
Oh, I'm sorry, there is no equity split. They get 100% of the equity. I'm sorry.
Yeah, no, I want to make sure our attendees don't get confused, but there's no equity split.
Thank you. It's been a crazy morning. So yeah, no, there is no equity split. Whatever equity is, whatever appreciation comes over the next few years. So the entity took the difference between the 30-year payoff and the option price. This was the explanation of the 30-year mortgage for the Tule River versus the 40-year homeownership agreement that your home buyer is on.
And just know that the home buyer is going to get a statement every month, and it'll have their payoff every month. Every month they'll know exactly how much their payoff is. But there's no equity split on this program.
Right. It's just the differential from the 30-year versus the 40-year EEP structure. That's the difference that I was referencing in. But they get all of the equity. All of the appreciation is theirs. This might be a state-specific question. I'm in Texas. If the entity owns a home, then there cannot be a homestead exemption with the counties, correct? So this is going to be a case-by-case scenario. I have seen some counties acknowledge the homeownership agreement and give the homestead exemption, but I've seen others that have said no. So that's just going to be something that your home buyer is going to, take risk. And after closing, they can take their documents into county, and county might grant them the homestead, but another county might not.
I think that's it, Monique.
Hey. Well, thank you guys so much for joining us today and all of your questions. And like I said, Norma and I are here to help you through the process, and we look forward to working with you guys.
Yeah, and continue to reach out to us. Like I said, Monique and I are available to you guys via email, phone. We'll definitely do everything in our power to get back to you on this program. We definitely want to see you guys and help you guys with those loans.
Thank you, everybody. Bye-bye.
Have a good afternoon.